Testing, 1, 2, 3, testing. Hi, good morning, everybody. Make sure I'm unmuted here. I found my mouse. We have a lot to get through today, so I'm going to start promptly at 8 o'clock. I see we have 3 people watching on the YouTube live stream. I may be one of those, but that's good. As I indicated, if you like, please put your name and some biographical information into the chat window on YouTube or here on the Zoom, wherever you are. And if you're watching this as a recording at some time after the actual date, then please let me know your thoughts on the video after you watch it. Okay, I have 3 minutes until the meeting. Also, I invite you to subscribe to the YouTube channel. I see I have 35 subscribers right now, so let's see if we can get that number up. I'll also put the YouTube link right here in the Zoom chat, and then I'm going to start. I'm just waiting for 8 o'clock, exactly 8 o'clock here in New York. Okay, here we go. Good morning. Welcome to MRMD. These are model risk management discussions, and you can also say mermaid. This is mermaid number 18, and I'll describe a little bit more of that in a slide in just a moment. But welcome to everybody, and we do have a fair amount of material to get through today, and I have a crazy schedule, so I'm going to start right away. I'm going to share my screen. And let's go to slideshow. Right, so this morning, or whatever time zone that you're in this evening, I'm going to talk to you about validating market risk models. You can see in the word cloud here, there are a lot of considerations about those. I'll be focusing mainly on VAR, value at risk. I'm also going to be drawing on previous MRMDs, especially the last two, number 16 and number 17. If I remember correctly, the citations in the PowerPoint are correct, but 16 was a deep dive into AI data and also some data techniques, such as the use of autocorrelation functions, ARIMA, and so on. And 17, which is just the immediate prior, a week ago, was on counterparty credit risk. So I've already explained that MRMD means mermaid. Why are we doing this? What's the motivation? Well, I'm a co-author with two others on a new book for model risk management. Not just a new book. This is a textbook, the first textbook. So it's going to have homework problems and some examples of how you might construct some of the constructs, some of the things that you need to build, for example, to validate risk models, to validate market risk models, and also to validate pricing models. So then one purpose of MRMD, these meetings, is to preview some of the book content and also to invite comment. I should say, and this is new, that MRMD is moving to Wednesdays at 9 a.m. ET. I'll show you a slide about the kind of musical chairs or chaos of the coming fall time changes. Fall is more confusing than spring. Spring, there's a larger interval between what the US does and what Europe does. So there are 6 topics we'll cover. The first is validating market risk models in general. The second, then we talk about validating VAR in particular. We then show that VAR is not an example of a coherent risk measure, and what implications that has. And we introduce expected shortfall because it is a coherent risk measure. Then in the right box over here, it's about, the actual hard work, once we have that out of the way, of what we do with testing the inputs. If the inputs are not great, then there are ways to cure those inputs. And then, of course, testing the outputs and interpreting the results. So Bob Dylan said, the times, they are changing. And in particular, time zones are changing. Here, I'm comparing New York and London, but as London goes, so goes the rest of Europe, just offset by hours. So today is September 24th. So in about 4 weeks, for the next 4 weeks, New York and London will be 5 hours apart, and we're both on summertime. In the US, that's called EDT. I know a lot of people say EST, but daylight time is when you add the hour to get the extra hour of daylight. And the equivalent in the UK is BST, British Summertime. So you can see S can mean standard, which is not summer, and summer, which is summer. Okay, so then what happens is the Brits change on October 27th. And so then for a little time, what is that, a week or so, there's a period where London and New York are 4 hours apart. London is now on GMT, which is the ordinary standard time in London, also called UTC for those of us who had a background in working with time systems. And then after November 3rd, we get back again and we're now both on standard time. All right, now that we have that out of the way, let's talk a little bit more about the meat of this talk, or the vegan equivalent. So we're going to talk here about the scope of what a model risk model means. MR here is model risk, market risk, not model risk, and the motivation for validating these models. Right. So broadly speaking, one could use either stress testing, so sort of a jump type of thing, or a statistical model. Stress testing, you can use any scenario you want, an actual historical scenario, or just say, the S&P goes down 50% in one day. The reason that, those are all useful, worst cases and things like that, but they may not be terribly helpful. Whereas a statistical model is something that at least you think you have some understanding of how often a big loss might happen. And in particular, we are addressing distributional effects. These systems have one feature, and that is that the profit loss distribution has a fat left tail. So it has negative skew and positive excess kurtosis, or leptokurticity, if you want. So like the mouse in the picture, this is something which has a fat tail. Since it has a fat tail, that's clearly a deviation from a normal distribution. And so the mean and the variance that we use to describe that, or the mean and the standard deviation, don't fully describe the risk. In fact, they underestimate it, because just like in this little guy's tail, your loss could be way out over there. It could be big. It may be rare, but it's big. One would think that one could just add moments like skew and kurtosis, but I've shown in previous talks in the series that under most conditions in financial time series, you don't have enough data points to really define the skew and the kurtosis within the standard error. So it's basically noise. We see skew, we see kurtosis, but with only 250 data points, like every trading day for a year, it's pretty difficult to nail down what the value of that skew is, or even to show that it's, statistically significant from zero. So instead, one looks at the distribution, but one has to look more at specific points in the tail, or an average of points in the tail. The specific points in the tail, I'll let you read the cartoon for a minute. In the US, we used to have these things where you would put in a coin. This is well before iPhones and so on, where you put in 50 cents or a quarter and you would hear the sound of something. So this is harking back to that. I'm not sure what the stock market would sound like if it were crashing. So how do you deal with these percentiles? So you could, for instance, just report the loss at that percentile and say at this M%, the loss would be this. Conventionally, that's at the 99th percentile for regulatory VAR, for reporting to regulators, but a lower percentile, 95th percent, for internal. Another way to look at this, what I call an alternative metric or alternate metric, is to do an average in the tail. So that's usually called expected shortfall. You can also call it conditional VAR, which is the VAR essentially just represented by the whole tail. Formally, it's just the average of losses greater than a certain percentile. But it gets complicated from there. The other one you can criticize VAR because it's a point estimate. And who cares what the 99% loss is? You really, how do you know that you're going to have exactly the 99% loss, that's what you're going to see? Whereas in this case, you're essentially saying, here's the tail loss. It has some nice mathematical properties. The chief thing that it can't be done is it can't be easily back tested. And we'll talk more about back testing later. Whereas with VAR, the back testing is, you're just talking about looking at binomial distributions, which most people can understand pretty intuitively. I do want to emphasize, as I did in the prior talk, MRMD number 17, that in risk management, we generally are dealing with a physical measure or P measure. So PFE, for instance, is using historically derived probabilities versus CVA, which on the desk, essentially, you can look at present probabilities. These are risk neutral probabilities, so the Q measure. But you don't have that in the case of risk. It's worth noting that later I'll talk about using first and second order Greeks like delta and gamma and vega in a VAR calculation. That's kind of a mixing of these two because those are really calculating in the Q measure, the pricing measure, yet you're going to be applying them to historical scenarios. So use that with caution. That's one reason not to use that delta gamma method. Anyway, we take in data, past interest rates, FX rates, prices, correlations. But remember, we are dealing with the P measure. We're dealing with history that's already happened, all right? And just like they say about investments for an asset manager, the past performance of this portfolio can't predict the future performance. So likewise, the losses in the past or the risks in the past may under or over predict the future risks. I think the best example of that is the Titanic, right? Everybody knows the Titanic hit an iceberg, and most people know that they didn't have enough lifeboats. So why didn't they have enough lifeboats? That sounds like bad risk management. Well, they were looking backward, and they said, how many lifeboats do we need based on all the boating accidents that we've seen in the past? And there had never been a Titanic, so therefore they underestimated the risk and did not put enough lifeboats. So that's just to say that one has to have a healthy degree of skepticism when interpreting things that are based just on history. I think it's also hard in mathematical terms to get your hand around a distribution, even a point in the distribution. It's clear that percentiles are not additive in the sense that even with just a small number of assets, the 99th percentile of the full portfolio is not the sum of the 99th percentiles of the profit loss distribution of the individual ones. For one thing, some of them may be profitable primarily, not have fat tails or not really big fat tails. The other thing about percentiles is that just like the ones I described a few MRMDs ago, any measurement in a finite sample is going to have sampling error, standard errors. Error bars is what we used to call them in my life in physics. But so any quantity is going to, have some issues like that. And I may have gone past it briefly, but the actual formal tail of the expected shortfall, one of my co-authors, Martin Goldberg, on the book, has made me well aware that if you are going to be integrated out the tail, then you have to assume some form for the tail, and yet it's an unknown distribution. So that creates some uncertainty, some possible inaccuracy. All right, so how do you validate VAR? Well, first of all, the history is simply that it came from a 1980s request by the CEO of JP Morgan to have some sort of estimate of how much could I lose on the following business day at the close of business today. So what that means is it's really today's closing portfolio that's the heart of the calculation. And so therefore, if we calculate VAR every day, there'll be a different portfolio. Let me introduce then the subject of historical simulation. So let's fix that portfolio, fix those allocations, and now do a thought experiment, if you will, that we look back 250 trading days, which is a year in my definition, and we look at the day-to-day changes, from day 250 to 249, 249 to 248, and so on, up to the present. We can then expose those to the portfolio that we took a snapshot of today and determine the daily profits and losses for each of those assets and for the portfolio as a whole. And then we can compute, 250 P&Ls. Then we can make a distribution of those and read off the percentile loss. That's the historical method. I'm briefly going to touch on two other methods. The historical method by far is what Wall Street banks use. There is, however, a Monte Carlo method. And in the case of PFE, as I showed in the last MRMD, number 17, you can only use Monte Carlos. There is no equivalent of historical P&Ls for PFE. It's only model. So, if you want to do a big Monte Carlo, I should say it's not entirely in the Monte Carlo. I mean, you can simulate stochastic prices like factors or prices or rates and so on, but then you still have some sort of, variance covariance matrix. That's what I mean by VCV. Variances on the diagonal and covariances of the off diagonals. A large matrix of factors or whatever, and then you can create correlated variables to simulate using something like the Cholesky decomposition or a similar decomposition. So, but that raises a whole other host of issues that were discussed in PFE. There's variance, and there's variance in the sense that it's finite sampling again. How it goes down with the number of realizations was discussed more there, but basically, for just any old like Excel type generator, it's 1/square root of n in the number of iterations. So you have to go, realization. So you have to do 100 times the number of realizations to get a factor of 10 lower in the variance. We also discussed seed variance, and that's a topic that I came up with simply because you can't just use one seed and go to the regulator and say, I calculated VAR with a seed of 7. No, that doesn't work. And are you going to make sure that it's always used in the same way across different systems? So I explained there that one also needs to look at, it's essentially the bivariate distribution of the seeds and the results from the increase in the number of realizations from 100 to 1,000 to 10,000. There is one approach. So Citi had a big Monte Carlo for a while. I think they may have that, but very few of the other banks ever used Monte Carlo or use it now. There is one other approach. I did talk about factors before. So if you have a large linear model, and I emphasize the word linear, then you can essentially look at the largest eigenvectors. So these are the largest components, somewhat similar to like a principal components. And then again, you can look at how that changes. In this case, for those factors, though, we really only have the first and second moments. We have the variance and the covariance. So if we're really trying to model the tail, it's, you would think that there are ways to address variance and covariance for skew and kurtosis, but then you're sort of breaking the problem into other problems. Um, Also, that variance covariance matrix, that would change every day, let's say looking back 250 days. And finally, I've written about this. I haven't presented an MRMD. There's standard error in calculating covariances and variances. Anyway, we're going to focus on historical VAR, which is the one where you look 250 days back and look at the actual market moves. Now, you do have to reprice every day, but how do you do that? Well, if it's something like a listed stock, then you just have to be careful that you can look up what the price was that day, or an index like the S&P 500. Of course, you have to have details like know whether they're corporate actions in individual stocks, and an index as well, when dividends are paid, when members come in and out of the index, etc. There are other simple products such as cash bonds. And for those, we can make some simple models such as, OAS or Z spread or something like that. In other words, a model that samples the variance in the interest rates, but also in credit or in spreads. Hazard rates, it's another way to look at it. And quite a bit of that was discussed in the last talk about how one looks at credit, CVA, and so on. And one can also do simple options like a European swaption or cap or floor. Stock index options are generally European options. So, we know how to price calls and puts with Black-Scholes. We know how to price swaptions, caps, and floors with Black 76 and the Black vols. There are some considerations, though, like a 3-month option that you held in the portfolio today. How are you going to do that? Are you going to say that on each of those 250 days, you started off with a fresh 3-month option? Or are you going to start with 250 days and then the option gets closer to maturity every day? And then what do you do since you're looking back at a year? The 3-month option is in the portfolio today. So how could it be in the portfolio today if, and today it's probably aged anyway, unless you've bought it today. So some complications. For the more complex products, there's 2 choices. There's full revaluation, or there's other methods. Full revaluation is what it sounds like. You use a calibrated model. So that could be a PDE solver like Crank Nicholson in the space of, the asset value and time. One can also use trees, especially if there's early exercise. And one can use, American Monte Carlo, which is a combination of those two. Or one could just use Monte Carlo for things like Asians. But those are slow. And you can imagine if you're doing a Monte Carlo VAR and the elements of your portfolio each need a Monte Carlo, then you're doing Monte Carlos on top of Monte Carlos, introducing variance and also really slowing things down potentially. So one thing that people can do is they can just look at Taylor expansions. Forgive me, this is a Taylor, but the cartoon or the meme is a Taylor. But you could look at the first order Greeks like delta and vega. You can look at gamma, second order. So you're approximating prices with a quadratic function of some kind in the asset value. So therefore, that'll be faster. But the question is it accurate enough? Is it biased? And so on and so forth. And that's not taking into account, rate changes as well. That's just the asset. I just wanted to note that where this ends up is either with regulators or with internal use, meaning audit scrutinizes it, the board somewhat, the risk committee, the CRO. For the regulators, it's fairly prescriptive. It's reported quarterly, it's 99% VAR, and it's a 1-year look back. So we can distinguish between ordinary or non-stressed VAR and stressed VAR. Stressed VAR being introduced, as it says on the slide, during the great financial crisis. So ordinary VAR is just look 250 days prior to today's close. Whereas stress VAR is look historically for a period of market stress and compute VAR. Again, that raises questions, will the next stress period look exactly like historical stress periods? But the outcome of all this is called reg cap, or regulatory capital, and that's going to be used on, how liquid your company can be, in the same sense that CCAR tests do that. CCAR and stress tests were discussed in a previous MRMD. For internal use, I think it's more common to use 95% VAR. Again, one uses a one-year look back, but it could be reported daily or weekly, or certainly more frequently than quarterly. And that's because the economic capital, which is the output of that calculation, is something that, might change strategy for the bank. Also, internally, the decomposition is important. Just like, there's a concept in asset management that one of your positions may be a hotspot. It may be accounting for 20, 30% of the inability of a portfolio to follow the S&P 500, that this one stock keeps pulling it below. So decomposing either into positions, or we'll discuss other ones, is important. But there are issues with that, and that has to do with the fact that VAR is not a coherent measure. In particular, it doesn't possess the mathematical property of subadditivity. And that's a good introduction. So coherent risk measures, we're definitely going to talk about subadditivity and some other properties. And we'll show that VAR is not subadditive, but expected shortfall is. So coherent risk measures, there are about 5 or 6 different properties. Ones that are kind of trivial, like the risk of having nothing is nothing, right? That seems obvious, but I think that's called the normalization property. But consider portfolios Z, Z1, and Z2 on a linear function space that's a script L, and some constant alpha and some measure rho. So rho could be expected shortfall, or it could be VAR. So here are 3 properties. Monotonicity basically says that an asset worth more, in the positive sense, has less risk than an asset worth less, right? Kind of makes sense. Z1 could be increasing in value, Z2 could be decreasing in value, and hence more risky. Subadditivity, which I've mentioned a few times, is just this. Pure additivity would be that the risk of the combined portfolio of holding Z1 plus Z2 is equal to the individual risks. Subadditivity means that it's less than or equal to. I'll give an example of that just in an ordinary function. But that's important. That's basically giving you credit for diversification, because one would think that the more assets one adds, at least you can diversify away the market risk, the so-called, like the systematic risk in the capital asset pricing model. And then finally, is just homogeneity, which may be obvious from here. It's kind of a linearity property as well, that if there's a factor alpha, like 2, like if you double the size of the portfolio, you'll double the risk. You won't double it in percentage terms, but you'll double it in dollar terms or euro terms, whatever currency you're using. I'm just going to focus on subadditivity from now on in this section. And intuitively, one would like to have diversification, that holding 2 positions should be less risky than separately. So the obvious problem with that with VAR is that they're percentiles. And as I explained before, the percentile of the joint distribution is not the sum of the percentiles from the individual ones. These are distributions. Let me show in a little detail that expected shortfall, however, is subadditive. It's actually additive. So remember, expected shortfall is an average over the tails. So the worst 13 days would be the 5% of 250 days looking back. So let's just start off with two assets, and we have the 13th worst losses for each of those. And we can also add the tails together. Then we just use the familiar property that the average of a sum is the sum of the averages. So expected shortfall is additive. That's an equal sign above in the subadditivity definition. Just an example of a function that is subadditive. So square root of x plus y is always going to be less than or equal to the sum of the square roots, as long as x and y are real, right? If I guess I should say, as long as x and y are positive, so that the square root is a real number, a positive number. The yeah, I'm messing that up. Anyway, x and y under normal circumstances, square root function will do this. I didn't say that well. We said ES is additive. I mean, the consequence of lacking subadditivity is, in practical terms, that we have to do groupings, and if we do groupings, let's say the firm-wide portfolio versus just the stocks, just the bonds, just the pounds, just sterling, just US dollars, that you're not going to be able to sum over currencies or sum over instrument type and recover the VAR of everything. There is a saving grace here, and that is that you can use marginals. So we defined marginal PFE in the last talk. Marginal VAR is defined the same way. It's if you imagine a multi-asset portfolio, then for each asset, you decrease the amount of that by a small percent, let's say 1%, and then consider that change to VAR. So in the limit that those small changes are infinitesimal, you're essentially taking a portfolio, which I represent here as the sum of weights times the asset values, and you're taking the derivative with respect to weight. So a sum is certainly linear, and the derivative of the sum is a sum of the derivatives. So MVAR is not just subadditive, it's additive. So some institutions will show the VAR for the different components, but they'll also show the MVAR for those components. And this does answer the question I asked before of, which are the ones that are contributing most to VAR. MR assigned, of course. Removing an asset may reduce the VAR, or it may increase the VAR. For example, long and short positions. So you can see which assets essentially are giving you good diversification and which are not. So here in the second half of the talk, I want to remind you that we are talking about the details that one would do as a validator on these models. So looking at the input data, the basic input data being P&Ls or something like that, like the price distribution of the distribution of returns. We'll also cover normality, stationarity, briefly on mean reversion, and then talk about constant variance. So if you take one of these P&L distributions, there are various tests to see how normal it actually is. We've said there's a tail, so we know that, in general, for the bank's portfolio, there are going to be big losses. But the individual distributions that we get, it's useful to see how close they are to normality. and the familiar Kolmogorov-Smirnov test can test essentially how normal a distribution is, or essentially, the null hypothesis is that it is normal. So can you null that hypothesis? The alternative, obviously, is that it is normal, right? So, and that's basically done by just looking at the supremum, if you like, the maximum of Fn of x, which is the observed cumulative density function, minus that which you would get from a known distribution, like a normal distribution. One could use that on any distribution for which var are input data. Let me talk a little bit about the time series. Besides just the distribution, what do they look like in terms of some things that we've discussed recently, like autoregressive models, moving average models, integrated models, ARIMA in general. So it's first to say, if you haven't thought about this in detail, that you can't just use a series of prices, or let's say index values of the S&P 500 in general, because a $1 move in an $100 stock is different than a $1 move in a $10 stock. And it's hard to use a distribution like that, because again, it's level dependent. If the stock splits, you'll have a different distribution, right? Also, prices can be non-stationary. We discussed stationarity in MRMD number 16. Later, I'll just refer to some of the tests we did there. But it's basically that the moments of the distribution have to be relatively stable. Weak stationarity specifically is just that the mean and the variance have to be constant. And that's a favorable thing to do if one's looking at time series. Any trends in those things may be to do with the individual asset, and you may get confused and see that risk is increasing when in fact it's something very specific to that asset. Some stationarity is generally recovered if one uses returns instead of prices or rates. So it's common to use, for something like a stock price, to use relative returns or log returns. So the difference of logs, which is about equal to the, for a small change, I plus 1 being, the price tomorrow, quote unquote, let's say on day 249, over on 250 minus 1. In a rate series, we're more likely to use absolute returns. If the Fed changes rates by 50 basis points, then that's what we look at. We don't really look at, that it went from 5 point something to 5 point something else. Excuse me. So yeah, take a look at MRMD number 15. What I showed there is that mean reversion needs to be tested before stationarity to get the right picture. And the mean reversion is something that I haven't seen that commonly in VAR analysis, that one needs to calculate the Hurst exponent, and that will tell you whether it's a deterministic mean reversion, or whether it's more stochastic, so closer to Brownian motion. And then after doing mean reversion, one can do standard stationarity tests like ADF and KPSS. That in that case, you're sure that you're just looking for whether there's a unit root or not, or whether it's stationary by hypothesis testing. So it's good to have a stationary series. The other thing that can be an issue, I referred to that a minute ago, the volatility in individual assets. If the market is getting more volatile, then that's a problem, potentially a problem. And so one essentially wants to try to remove that. If not, then the VAR may be wrong, and you may underestimate or overestimate it. I think it's most useful to think about specific cases So in the case of Morgan Stanley, I actually worked on this problem. I arrived in 2012, and they had a problem with their one day VAR because instead of using a 1 year look back, they used a 4 year look back. So it's not complex arithmetic to see then that at the beginning of 2012, they were entering a period where now they would be sampling 4 years back into the heart of the financial crisis in 2008. They felt then that the VAR that they were reporting to the regulators resulted in punitive capital considerations. They essentially had to lock down their liquidity. Another example is Russia invading Ukraine in 2022. The chart below is Euribor 3-month. Euribor is like what used to be US LIBOR. It's a very common rate for borrowers other than governments. Currently, we use SOFR in the US. But here's Euribor over 3 years. And so at the beginning of this series, it's well before the 2022 invasion of Kiev, of Ukraine, right? And rates were actually negative, which was a characteristic of European rates. They allowed them essentially to go negative after the great financial crisis and had them negative for a while. So that shouldn't surprise you. After the crisis in late 2022, the rates broke zero, as you can see, around September 2022. And in doing so, and through the entire successive period, you can see there are a lot more features that the Euribor is getting much more volatile. I would say it has increasing variance because it's easier to model variance than standard deviation. So that currently it's in the threes. It's 3.25. Yeah. So we want to get a handle on things like that. I mean, we can't just use something like LIBOR there because the background, the Russia-Ukraine war is so unusual that we might get, very punitive values of VAR. So we sort of want to take out the effect of the war or the effect of the great financial crisis and say, those were periods of very high variance. Well, we're not in a period of high variance now. So I'll talk about curing the variance in a minute, but let me first go back to the mean reversion and stationarity tests. So if you don't calculate the Hurst exponent and see whether mean reversion is there or not, then essentially you're entering the world of the stationarity tests with some lack of knowledge. And the symptom of that is that you'll find that one test, let's say the ADF test, will pass and the other test will fail, or the other way around. If you've removed the mean reversion and they are truly stationary, then you'll be right here where both pass. But if you don't, there's actually some information in the ADF and in the KPSS tests. If it passes the ADF test and fails the KPSS test, then I have here, it's called difference stationary. And that means that first differences, which essentially is what returns are, will likely make the series stationary. A related issue is what's called trend stationarity. That would be a failure of ADF and a pass of KBSS. That's like if you imagine a linear trend. So if you have a linear trend in the data, then you can do things like do least squares, linear regression, and subtract that out. So now let's attack non-constant variance, which is what we saw before. From a statistical basis, variance is usually like the square of returns. So the first thing to check is to see if square returns are autocorrelated. Why would they be autocorrelated? Well, they cluster at high variance, let's say, in the period of the great financial crisis only, or after Russia invaded Ukraine only. And there's a standard test once one calculates the autocorrelation function of those squared returns to see whether there's a statistically significant autocorrelation at whatever lags. I would look at the one-day lags for sure first. And that's the lung box test. So that can give you a p-value and so on. It's a hypothesis test of whether there's autocorrelation or not. In this case, then, if you find autocorrelation, then perhaps we can rescale the data. This is the idea, so that the autocorrelation goes away. Essentially, what we're doing is we're going to be dividing by the variance. So if during the great financial crisis, the variance was a factor of 10 larger than now, then we should recognize that, and we should do our scenarios back then, but change the variance to 1/10 of what was actually observed in the financial crisis. There are several ways to do that. The simplest, they all require introducing new parameters. The simplest is a one-parameter model, which is shown here. It relates the ith sigma squared to the ith variance of returns to the I minus 1th. So today relative to yesterday. If you just look at the first two terms, you know, that's if lambda equals 1, then it's constant, right? If lambda is close to 1, which in practice it is, then it's going to slowly change over time, like 0.99 or something. I say here lambda is typically 0.95 to 99. As far as the second term, well, you know, if lambda equals 0, then essentially the variance is the squared returns constantly. So we're mixing in a little bit of prior variances and the prior squared returns. Of course, introducing the parameter means that now we are sort of filtering the data. Riskmetrics, who pioneered this, showed that essentially if you know the percentile p and you pick a lambda, then you can calculate what the effective look back is. So 99% var, reg var, lambda equals 0.95 is effectively considering this equation up here in sigma squared going back to about 90 days. That's a bit of a smoothing. So one can then calculate what I call SR of t, the scaled returns, and define t equals 0 as today. Then t is going backwards, which basically it has been for most of this talk, but I didn't emphasize that. So then the scaled returns are simply scaled by today's variance, which is observable, over the modeled variance, sigma of t, at any given t. Fine. So now we have a set of scaled returns. And this is basically what I was saying before, that then one anticipates then the scaled returns, then the autocorrelation of, it should be the squared returns, is now close to 0. You again run the long box test, and if everything's okay, then now we're going to rerun the var, but using these scaled returns. I want to talk then, this is actually the last section. There is no section 7. I was not telling the truth. I incorporated the different risk measures. I compared expected shortfall to var, so you're not missing anything. But this is about standard errors of measurement, again, covered thoroughly for the first 4 moments of a distribution in previous talks, but now we're going to extend it to percentile standard errors of measurement, a little bit about back testing and traffic light tests. I see that we're getting close to the top of the hour. I think I can do another 5 minutes, 5 minutes of questions, and then probably have to finish at least not too far after the top of the hour, which is 9 o'clock here in Brooklyn. Okay, so there's no question, first of all, just as there is with mean variance skew and kurtosis, that in a finite sample, there are sampling errors. In physics, which was my first career, we call those error bars. But I've never seen an error bar on a mean, a variance, a var, a percentile, or whatever. Even though those errors can be pretty big, maybe that's why they don't use the error bars. So this I said before, it's a percentile. Um, let me just do a quick statistical lesson here because we're used to thinking about the first four moments, which are, group statistics, um, multivariate. The other way to look at the distribution is simply to rank the observations. So if we have a little n number of independent observations of this profit loss distribution, then we can rank those. And the order statistics are basically the number one is the minimum, the nth is the maximum, and the others are just, these are now sorted in increasing value. So again, let's think about this, because you thought big var. Well, a big var is big and negative. So really it's, you expect that a 99% var should be close to the minimum of the observations. But we can do better than that. We can actually look specifically of ordered statistic distributions, and from that get to percentile distributions. And these are done just in terms of the CDF. I thought this was a nice calculation, so I'll show this. So the distribution, the CDF of the first order statistic is just this, right? You're just saying that any value that you select will be greater than or equal to the minimum. This is the complementary probability, and it's easy to calculate because by assumption, these are independent measurements. So therefore, it's just the product of all of these. So that one has, at the end of the day, and this is true for a general distribution, that the first, any distribution, if you tell me the CDF, then I can calculate the distribution of or the CDF of the first order statistic. From that, I can calculate the PDF, and that's just the derivative with respect to X, right? Standard. Of course, we may not know the PDF. We may not know the CDF more in particular. And so for a general distribution, an unknown distribution, this hasn't bought us that much. So imagine this then. Imagine, though, that even though I've been talking a lot about tails and things, if you have a large number of observations, I'll show you what that means later, then you can essentially have a very well-defined low statistical error percentile, low standard errors. So permit me to use asymptotic normality, then one can actually define a mean and a variance of a particular percentile p, right? Here it would be like 0.99. So, but as I look at my notes here, I'm reminded that it's actually 0.01 because again, it's in math, this is the lowest, not an absolute value. I mean, it's the highest in maybe an absolute value, but it's the left curve, so it's the most negative value. So that's really the first percentile. And 95th is the fifth percentile. So the statement is that a percentile will have will asymptotically have a normal distribution where essentially the value, the percentile is gives you the mean. That number you already know. That's the thing that you're reporting as whatever, how many billions dollars versus var. And then the variance is given by this. So this is the product of, let's say, 0.01 times 0.99. The number of observations enters into it. This is variance. So the standard deviation is going to be 1 over the square root of n as before. And then within this is nested, but you need to know the CDF and the PDF of the distribution. So again, suspend disbelief for a minute here. Let's say that we can use the normal distribution F and PDF. So if you do that, the mean of the distribution in terms of the Z variable is minus 1.64, you can think of that as zero mean standard normal. And so we're 1.64 distribution standard deviations below the mean. And the first, which is again the 99%, is 2.33, right? So now the standard error is going to depend on the sample size. And the way that goes is in terms of the days, 1250, 5,000. See, I'm just up at 855. So I just wanted to show quickly here that an example. So Citi, I may have mentioned before, reported at the first percentile a 99% VAR of $12 billion recently in March. So you say, oh, 12 billion. Yes, but there's a sampling error. In this case, I'm going to take that to give a range that's plus or minus 2 standard errors, which is what the sigma is here. And you can see it's fairly large for 1 year. It's going to be like 10%, right? So 10% of 12 billion, obviously 1.2 billion. So two standard errors rather, gives you a fairly wide range from 10 to, close to 15 billion. I guess you could say 2 to 3 billion is not very much, but to me, that's, at least in absolute terms, a huge, huge confidence interval. And indeed, maybe they should be reporting the conservative value, which would be 14.4. Just briefly showing that the way regulators think about this, they have 3 zones: a green zone, a yellow zone, and a red zone. So these are showing the number of exceptions in 250 days of observations. And so, 1%, so it should be about 2.5 on, it should be around here. And they're okay with that. We can discuss what these probabilities mean offline. But even with 4, from a number that's 2.5, however, if you enter the yellow zone, then you start getting scaling factors. So this is essentially saying at 5 breaks that you have to increase the scaling factor. You have to increase the amount of VAR for regulatory purposes by a factor of 1.4. Indeed, if you get into the red zone, you're now doubled the reported VAR. Yeah, we're running out of time. I should just say, if you look up this paper or look up papers by Christofferson et al., that we can do more with the breaks besides just count them. We can look at their distribution. We can look at the traffic light test, which I just showed you a minute ago, which is due to Basel. And we also should have independence, so we should not have any sort of autocorrelation in those breaks. All right, well, 2 minutes to go here. It's just in this deck, which I'll show, it shows you how to get to the weekly MRMDs. Again, they're shifting to 9 a.m. on Wednesdays. I can't spell the word Wednesday, it looks like. And they are live streamed, and the live stream is also an archive for viewing anytime. The last slide is just my contact information. So with that, I'm going to stop sharing. I see Greg is on. We had some people who joined and left. I can also try to, if I'm smart enough, I can try to figure out the, I can't get this on my other screen. So the floor is open for questions. Probably just only take about 5 minutes because it's a crazy day for me. For Greg or anyone else. I'm trying to get up the YouTube window, which is that. And then where's the chat part of the YouTube window? Okay, I'll just say any questions.
Jonathan, no question. Can you hear me okay?
Yeah, fine. I'm just trying to
Okay,
get.
no questions for me. In terms of going back to earlier sessions,
Right.
where would I find those? Can you show me?
Yeah, so
Because I want to go look at the CCAR one is today.
Right. What I should do, YouTube's good at storing videos, so you can definitely, watch the other ones and hopefully they're titled right. But it doesn't really support, the documents, so you won't have the PowerPoints there.
Okay,
The PowerPoints, what I've got to do is just, trying to keep my head above water on the book, which is behind this, and
okay.
having this upcoming December 1st deadline. But ideally, I do have this corporate website, delta-vega.com, and it would be easy, I think, if I can remember how to put documents up there,
Yeah.
then I could have, like a whole page, and then you could see all of those. I
So the
can,
best thing to do for today, if I want to go look at CCAR, is test is go to the YouTube.
yeah, I can see,
I'm not
yeah,
sure what to look at. Uh,
no, that's fine. I have I
can you
can pop
flash
it up.
something up, and I'll just know where to go.
Yeah, I'll send around the slides, and that has the YouTube channel link in it, or I can just email it to you. I'm seeing
Send slides. Okay, that's good.
which, like, I need really uh a spreadsheet in here saying what's what. That would be a useful thing, because I don't now remember what secret. I mean, basically everything's posted in LinkedIn, but looking through LinkedIn is like looking through the back of your closet, right? So
Right, right.
it looks like 12 was on book reviews, number 13 standard errors. So maybe 14 was op risk. Um, I thought I gave one on stress testing. I just don't know where it is. Yeah. And there are ones before that, but I may not have. Yeah. Okay. Uh, CCR, that's not the same thing as CCAR. Um, I mentioned CCAR. I don't know whether I devoted a whole talk to it.
Well, any kind of stress testing, I'll look at it.
Yeah, my method usually is to put the minutes and the and today's slides up just in the LinkedIn feed.
Okay,
Um,
I'll go to the LinkedIn feed, and
yeah,
then
so the last two definitely this depends on, number 17 and number 16. And I don't want to, well, I don't want to have people running all over the place. You sort of feel like if you lectured about the quadratic formula, last week, you shouldn't have to lecture about it again, this kind of thing.
thanks very much for providing this.
Sure.
And then the next one is Wednesday at 9 o'clock. It's the next one,
Yeah, a week from Wednesday, a week from tomorrow. Yeah.
a week from tomorrow. Okay, and then do you think you'll have any time for lunch on Friday,
Yeah. I was
or we
actually
can make
planning
another
on it.
day?
And then since it is a Friday, maybe even staying in the city after that. I don't have anything. Yeah. So I have us down as question mark Greg for lunch. Yeah.
But are you in the city? Are you in Manhattan anyway on Friday? You're already there. I
No,
don't
I
want
was
you to
gonna
make a
come in for
special
that,
trip.
but then I may get together with people in the evening, so I was gonna use it as a jumping off point. And it's nice to get outside the house. I'm actually at my beach place this morning,
Uh-huh.
and now I have to rush back to Brooklyn. But I like even at home, I like working outside. It's
Okay.
without a day job, just having the book there the whole time is,
Yeah.
I think writers are
24/7.
like that. They write and they drink, or they write and they whatever they do. It's
I'm
it's nice
trying to
to have
get
some variety.
exercise every day for that reason as well. Just
Yeah, so if
otherwise
I'm
it's
writing
12 or
at that,
14 days at the office.
exactly, I should definitely do more exercise. I do a little biking. I'm gonna miss that today.
Biking, I love, yeah. Well, um,
But yeah,
what would be a convenient location for you to get to on
if you
Friday?
want to talk, yeah, this is all recorded, so maybe
Oh, I'll get off this, yeah.
but maybe if you reach out to me, or one reaches out to the other on Thursday, I'll put a reminder if I don't have that, just to
Yeah,
set
okay,
something up.
Thursday we check in. Okay, I'm
It's
gonna go
Tuesday
to
or
the,
tomorrow. That's fine. Today is a bit busy.
yeah,
End
go
of the,
ahead. Thanks for, again, very much. I'm gonna go look through the
sure.
YouTube for the slides, right? I mean, I'll go to LinkedIn for the slides, right?
Yeah, that's the best thing to do for now. In explaining it to you, I'm realizing that I need a folder on my corporate website with a short table which says what's what, and then links to the PowerPoints. I don't,
Would you say you're teaching this at a PhD level?
I mean, the book is designed for first year masters, but the people in those masters financial engineering program, they they may be out of college, but they may be very strong. So essentially they
Yeah,
would be
okay.
or they may have developed the intuition, in working for a financial institution, like you have a lot of
Yeah.
work experience. in
Much
that.
of what you talked about is the MSc at London School of Economics, the MSc in Economics and Econometrics, much of
Right.
what you referred to, but there's some review for me on those tests, first test.
Yeah. The people play fast and loose with statistics. I had
Yeah,
an astronomy teacher gave he said, figures don't lie, but liars figure. Right.
well,
That's
I
a
just
good
want
one.
to be able to lie with the best of them, I guess.
Right.
Okay.
Yeah, that was Ivan King. That was who was teaching me in Berkeley, but he's a native Brooklynite, I remember, and
Ivan King. Okay.
he still has that accent out there, So,
Where
but
did you do your PhD in
at
physics?
Berkeley, but
Wow.
there are there are
My
no
Aikido sensei did his PhD at Berkeley.
yeah. I mean, it was a great place for physics, and it was great just to have everyone, core around that. And now I'm actually helping some astronomers, old colleagues at Harvard. There's a lady, she's on a postdoc in Prague right now, but she wants to switch fields and get into finance. So,
Of course.
I'm corrupting the youth, I guess, like the Pied Piper. Okay, let me
All
let
right,
you
we'll
go
check
because
in the next couple of days. Thank
it's a
you again.
crazy day. Thanks. Yeah,
All right,
take
good luck.
care.
Bye.
All right.